Okay. Hi, everyone. I'm Aoife Devitt, and welcome to this Markets Happy Hour podcast. We are here in sunny Barcelona, and we have an audience that may grow throughout the course of the podcast as they wander in from the event. But delighted to be joined here by some members of the financial community who will weigh in if asked, but only if they feel like it. So let me just go ahead and share the screen for the people on the recording. And every week we get together to discuss really 5 things that would be on our mind: inflation, interest rates, geopolitics, equity markets, and others. So Bitcoin, bonds, etc., no matter what's in their mind, or gold. And we really, the point of this is to discuss what this should mean for an average investment portfolio. So we have representatives from the institutional pension arena, from asset management, from private equity. I would be holding the hat or wearing the hat of the individual family office investor and think about what's for them. So this is my way every week of just kind of gathering and crystallizing thoughts of what we're seeing. So I suppose the themes of this week, it seems that we've gone from a narrative of American exceptionalism to sell USA. And that seemed to be a pendulum that swung very quickly. It seemed to be not only US bonds, US assets of any kind, US Treasury, certainly a safety, as well as the US dollar. And that phenomenon of selling USA seemed to be the new narrative. And it certainly was what caused many of our clients to be concerned that there might be some form of an exodus from US assets. We also this week had a series of false alarms, it seemed. The first false alarm was an actual error whereby the Trump administration sent to Harvard a letter suggesting they would be stripped of their tax status. That does seem to have triggered all kinds of reactions throughout Harvard, seems to have been sent in error, at which point that we could say that what are the other kind of false alarms that are out there? And I think we could also suggest that much of the recent tariff rhetoric has been a sort of series of sequential false alarms, and that we went kind of big initially on Liberation Day. And then there have been various false alarms along the way, suggesting that perhaps this wasn't as bad as seemed. And the most recent iteration of this false alarm is that even in China, looking to see what earnings tell us, as we have a bit more clarity this week in terms of earnings. And then, of course, the question for all clients at all times is, where do we go from here? And that is, I think, what we're trying to figure out. In terms of recession watching, so we've certainly now, the last few weeks, it's been all about recession. The question is, where do we Is the stock market a leading indicator? So is it already essentially, by the time a recession is declared, has the worst been over in stock markets? We can see that the 2008 recession wasn't confirmed until the S&P had fallen almost 50%. So the idea that at this level that we're going to get any kind of official confirmation is probably illusory. That's not coming. On the other hand, we know that the poly market, et cetera, certainly the odds of a recession have been rising. And I'd say what we can also have seen is just, we heard this discussion earlier about what kind of a recession is this. So whereas 2008 was a structural recession, we could have a cyclical recession that we would maybe have expected in 23, but never transpired. And this is then the self-inflicted wound, the event-driven recession, which according to statistics is shallower and shorter than a typical recession. But I think my concern is that this event-driven recession could become a structural recession, or could coincide with a cyclical recession, and that then could be something that's far. And we're lucky, our audience is directly split between Europe-based, or at least European origin investors and US. I'd love to hear whether mega is something that would make Europe great again. It is something that we in the US think of as a real phenomenon. What it actually feels like on the ground. We can maybe get to that in terms of the any thoughts, Alex?
Yeah, one question is, when you said, is there a recession yet? Which country are we talking about?
Yeah, that's true. Well, that was a question with the US.
US,
exactly. Country. But right. Tell me about what your perspective, you look across Europe.
Europe and Asia a lot, and I think the feeling in Asia has been preparing for this for a while, and I think they also have waited to use other, let's say, tools to boost their own economy. So I think, we may see a different picture, and we will see a different picture in Asia than US, and then Europe. Well, it will depend if they how they manage to actually create those alliances. But my view is that Europe has already suffered a lot from the Russia war, supply chain disruption in the past, energy and is learning how to weather those situations a lot better than it used to, and has actually gathered together much stronger than it has ever had. So I think it will come out stronger. That's my view. That's what I feel also, within the European business community.
And it's interesting, I think it's a question of pain threshold as well. I think we spoke in China about how China's pain threshold is actually quite a bit higher than we know that from COVID. It can have its population essentially frozen out for the rest of the world for 3 years, perhaps different political concerns in terms of election. And that pain threshold, I think that I would suggest that Europe is quite resilient because it has not exactly had a consumer boom. Spain is a great example. I mean, Spain was probably, it's up the highest growth rate in Europe, I think, recently.
For
Yeah.
quite a few years.
And how has Spain, is it because it got so bad that austerity just kicked in and eventually it couldn't go any worse? It had to come up? Or were there any, I suppose not commonly well known, perhaps, tools that was used to?
Yeah, I think Spain benefited from a labor force that is qualified and not necessarily as expensive as the rest of Europe. And I think a lot of companies sort of opened offices over here. The tourism has been a great important boost. But yes, so Spain has definitely benefited a lot.
Yeah, tourism. No, I think so that Spain depends a lot from tourism, and I think so. After COVID, the boom of tourism has been a tailwind from the Spain economy. And find all the labor force coming from other countries, immigration, is helping to that, no? Because people who has with low salaries, and it's supporting to this economical boost. No? Because, but in the long term, is Europe and Spain and Europe has a lot of headwinds, and they need to face the problems reality if they want to come back to the growth again and to on track.
No. But that's really interesting, because I think the narrative in the US is very narrow, that Europe had nothing but headwinds, not these tailwinds you mentioned. Because we heard about too much regulation, not enough innovation, the demographic problems in terms of population growth. But as you mentioned, this immigration problem perhaps is also a bonus, a benefit on the other hand. And equally, the socialized medicine problem can be in the short term a way to keep costs low. So it's an interesting phenomenon.
Yeah, what was the last time you heard the term pigs? Remember?
Yeah.
It's been at least 10 years, right?
Yeah.
It was everywhere, and then it just disappeared, and slowly and quietly those countries just got to work and went back on the upswing. So
And are not getting coverage, which is why it's so important to get around. And I think just
the sick man of Europe.
Right.
Yeah.
And
Right.
now it's about to
Now
be
it's
the
exactly.
growth driver of Europe.
yeah.
unintended consequences. I think it's interesting, that question you asked me, what I talk about recession, and of course I should have specified, because in a way, there's one argument to suggest, well, we're globally in sync here. It's a global recession. And I think that certainly seemed a little bit the case around Liberation Day. The big fall in markets was contagion around the world. Certainly would have been a disruptive effect around the world, and a suggestion that a slowing US would be contagious around the world. But equally, prior to Liberation Day, we had quite a bit of dispersion between the markets. I think it's safe to say that this tariff trade uncertainty has certainly looks like there will be no winners in this game. It will be a lose-lose scenario, whereby equally, the thing I thought was kind of amusing is even with this, in not a very funny way, but I mean, nonetheless, these negotiations with the 70 plus countries, it will by no means be easy, nor will they be achieved in 90 days. I think we have this no quick fix reality that is descending not only in tariff, but in Ukraine peace talks, in Gaza. I think we all know none of these are quick magic wand solutions, which again adds to the uncertainty that we had discussed. Another big divergence and I think now we've seen Twitter feeds, X feeds discussing European seventh rate cuts. I think that is a new buzzword that now we all are aware of. But we've been slowly tracking these rate cuts by the ECB. And the ECB has, I think, been quite satisfied with the move of inflation. It seems like it's very much in the rear view mirror, at least, or it's under control. They don't want to have the specter of stagflation, the stagnation that seems to be the case in the UK. They don't have inflation, so it's stagnation they can now address. And they seem to be quite confidently leaning into this easing monetary policy, which is now the envy, it seems, of the US, given the deficit. I'd love to know from a European perspective, is there support of this ECB policy? Rates falling, there's a sense that the ECB is ahead of the curve, given the Fed is often accused of being behind the curve?
Yeah, look, I think, the business community welcomes that. I don't think it's as much of a talk as it is in the US. It's not as politicized, but I think people have been used to very low rates for many, many years, and then a spike due to the energy prices and the war. So I think people are expecting that or seeing stability in prices today.
Yeah.
And therefore, I think, and given that the forecast of slowdown of activity, that people feel this is justified. I don't think there's a big dilemma or conflicts of point of opinions at the moment. At least I don't feel that generally in the community.
Yeah. Quite different from the rhetoric this week about firing Jerome Powell, then not firing Jerome Powell, and that seemed to give markets the kind of the boost they needed. I think we have been talking a lot about the Trump pot. Like, what is the Trump pot? What level of market pain is he going to not be prepared to tolerate? And I think it was a little bit, the level of pain was higher than many of us had thought. I think many of us had thought there would be no level of market pain that would be tolerated. But it does seem that this was a good quote, that capital markets are proven to be the only guardrail with sufficient power to defang the most extreme outcomes. Neither legislature, corporates, nor judiciary seem able to restrain the surging executive power that recognizes few checks and balances. So I think a fairly savage indictment there of the lack of checks and balances. But yet we're not completely devoid of checks and balances, that the capital markets are operating as the weighing machine that they should. And I'd say that there has been suggestion that they've actually now caused a blinking. That will probably not be admitted that it was a blink, certainly, but that when it comes to tariffs, as well as when it comes to Powell being fired, there's been kind of a rollback of that. And I think just to get to the sense of the uncertainty, I think in this, what we are quickly seeing is that there really is no kind of safe pair of hands, I suppose, or with the exception perhaps of Besant and Lutnick versus Navarro, it's difficult to know who has the ear of the president at any one time. And that, of course, makes predictability that much more difficult. And I think this is referring to even on the global stage, it's difficult to know how exactly to kind of manipulate this maneuver around a force like this. That seems to have been quite challenging. So I think that adds to the uncertainty. I think another point that is really a new development this week, I call this, is not just your imagination. Basically, the moves in the S&P have been quite extreme. And the yellow chart here showing just the implied moves higher or lower over the course, this is 24, going back to April, May, over the course of the year, that we can see that basically we have these implied moves getting a lot more frequent in the kind of the 1.5%, 2% level. And it's become the new normal. We've seen some charts comparing the last month to 1932 in terms of just the volatility and how the worst April this is. I'd say from our standpoint, I'd love to know how boards are receiving this, or in the OCIO world, how clients are receiving it. Our clients are generally long-term investors. We have high net worth individuals, family offices. It is certainly not the kind of stomach for volatility that we would even expect anyone to be trained for. So it is causing, it's the sound bites, it's the volatile swings. It is offering good tax loss harvesting opportunities. Very safe to say that's the one aspect of this, as well as structuring things like creating Roth IRAs and being able to take advantage of tax losses at this stage. And the institutional side, is this type of volatility causing angst more than usual, or do you find that you've coached your beneficiaries or your board well enough to withstand this?
Say the board, yes, not necessarily the members. We've fielded our own fair share of calls, and so we've had to put communications out there to say, hey, we're long-term investors, we're pretty diversified, and so we feel that the fund's in good shape. It's not necessarily fully inoculated. We'll take our lumps, but again, I think that general direction and tempo of being diversified and long-term investors is dampening any further calls. So
that's good to hear, and OCIO too.
Well, I mean, we are firm, I would say we're less than OCIO, but we definitely have some of those criteria. But as a private fund that does do some investing in other funds, yeah, sometimes it's better to be lucky than good, and other times it's better to both. That's ideal. We actually, over the last 2 years, have really pulled out a lot of the volatility in our portfolio. So we actually have a lot less market drag. So if we think about what happened in March, certainly we were affected like everyone, but it didn't cause a level of drawdown that the fund might have experienced in the past. We don't have the single name equities that we used to have. And a lot of what we're doing has really dampened the volatility just structurally from a portfolio allocation perspective. So a lot of what we're doing is clipping the coupon. And because rates are still high, we're continuing to clip a coupon that's higher. And in terms of some of the portfolios we have, some of those portfolios parts of them have not even been touched by the rate rises because they came so quickly. So we actually see, so from the perspective of our stakeholders or investors, they're actually fine with it. I had a consultant who said, "Thank you for the returns," which I wish I had reported that because I don't expect that ever
No,
hear that from a consultant ever again.
It's better.
Yeah. So I think we're in a good spot that, this is a project that we've been doing over the last couple of years to kind of be prepared for more market volatility. We have just added a little bit of back in the last sort of few months. But with a lot of risk mitigation.
Yeah.
So we're never going to get the upsides that we might have in the past, but a little less. So I think that's what our main pensions endowments foundations, those are what they want. Is from us at least, they want a bit more of a steady kind of high sharp, not so much fall, and they've been happy about that. I mean, we'll see. I mean, one of the conversations that you always have is when the markets are going 20% up last year, equities in the US 20% this, and like I expected to get some calls to say, well,
we're lagging.
yeah, but I'm certainly not saying it now.
Yeah, it's been a great. I'd love to at some point ask about the private market, what it's like to be a private market operator with the backdrop of this kind of volatility. Does this move the needle at all? Are you just eye on the prize in terms of the long-term market?
I guess obviously we are not directly impacted by the volatility of the markets, but indirectly we are in the same way impacted because we feel it, the pressure of our LPs. It's like I can remember, for example, I can remember how many calls we received when DeepSeek released in China, and we invest in tech. So and our LPs calling us, hey, why media is 20% for 20%, or right now in the same way, how tariffs are going to impact the portfolio. So public markets are is the feeling of the market, and private. Okay, we can, and the people know that private markets are. You can update the NAV every day or in real time, but they know that the value also evolves. Even anyway, and you don't. I update in real time.
Yeah.
So the pressure we feel in the same way.
Yeah. Would you say the same from your across your portfolio? The feeling of the market is translating into private equity angst?
I think the first thought of private equity operators and managers of business has been more the tariffs and how to manage that rather than the volatility in the market.
Yeah.
Really. The volatility in markets, I guess, the second thought would be, is it going to affect liquidity and any financing of my businesses? But apart from that, of course, if you're in a sale process or about to do an IPO, that volatility will affect you. But apart from that, I think it's more about how does it affect my business financing and tariffs, and how do I shift? That's what it is.
And you're probably counting your blessings that you are private, and not if you've decided to go private, or you don't have the burden of the constant discussions on the public market.
I know we have like 5 market was 5, 6 tech IPOs prepared for the real estate in the Nasdaq. Everyone is paused, so it's like a new year without liquidity in private markets. So it's even more tough for private market managers.
Yeah.
At least in one side, I think in the same way on your side.
Yeah, and look, I think it's just too early. People are pausing. They're
Mhm.
just saying, okay, let's wait a
Yeah.
little bit. We're only 2 weeks into this.
Yeah.
Is
that all?
It sounds like
Is that all? Yeah.
a lot longer. So let's see what another 2 weeks
Yeah.
says, so.
It's and it's just that is, I think, what we show here is now that we're in earnings season, where we've got to is just in terms of the word count, this red being the April, and what we're seeing, what are companies talking about? Well, more talk about a slowdown than they have been in past months and past quarters. This is a mark going back month to month. Supply chain issues a little bit. That's been worse in the past. Uncertainty, clearly major buzzword, and tariffs. And I think what we're also seeing is just a shift in consumer behavior. So we talked a little bit about the way well, we'll come to that in a second, but where are the areas of pockets of the market that are actually finding the bid at the moment? Safe havens clearly finding a strong bid in the aftermath, and the gold, again, most institutional investors will not be invested in gold, or at least they'll only be doing it in some derivative way. But clearly the vote of confidence, and this, I think, is all part of that Sell USA narrative, that kind of flight to safety. And we've had previous charts of the week showing alternative safety assets, whether it's German bonds, whether it's the yen or other forms of currency. It's where would be Swiss franc, exactly. Yeah. So that's really, and I think, again, in Europe, they're used to having a few options, not to be kind of a single one-trick pony in terms of a safety trade. And I heard this thing about trust, and trust has come up a lot on the breakdown of trust, and whether that is the big factor that undermines. I feel market cycles move quickly, and I'm not sure we're in this kind of massive, I'll never trust you ever again. I kind of feel that these are often, operators are relatively transactional. And I think that they're kind of have to build in, again, maybe especially in Europe. We've seen the Russian situation. We've seen pretty radical change in politics here. I think we're kind of used to not necessarily believing that a system stays the same way forever. So I feel that the focus on trust and it being sundered and never be the same again, I think that may repair more quickly than we think, whether it's the next administration or not. But clearly safe havens are definitely the order of the day right now. And I found this very interesting about where are the defensive stocks. So Walmart, clearly record high. Everyone wants to own the cheaper retailer at a time when we have the market conditions doing badly. But what I found I was talking about last week was this idea of the lipstick index. Netflix had jumped 24%. It was doing extremely well, and I likened it to the fact that lipstick is always a popular purchase in recession because it's a small little treat that doesn't cost a lot but makes you feel good, as a woman say. And Netflix is a small outlay on a monthly basis, a little bit of a treat, but it could be a substitute for spending in lots of other areas. So whether that be going out, traveling to Europe, actually going to the live theater or anything else. So I think the fact that Netflix, and we'll see more people staying at home, pulling in their expenditure horns and not spending as much.
Although my thesis on that is it's 74 million people in the United States who choose not to listen to what's going on that's being covered.
That's the right. Yeah. That's
Because that was the first thing I said. You know what? I said I don't want to have to. I was going to turn off New York Times, and I love the New York Times, but they were just going to cover everything that he did.
Yeah.
And I didn't want to have to read that.
Yeah.
We need to disconnect.
Yeah. Disconnect. Totally disconnect.
That's a real phenomenon.
Yeah.
And that's been a real phenomenon, at least in the US. It's just turn it off. I don't want to listen to it. Maybe I'll look at the notifications on my phone and I can choose to, but not actually watch it on TV. I mean, that's why CNN is down, and that's why MSNBC is down. Fox News is up, but I mean, that's a different phenomenon.
That's why I thought the pivot for MSNBC would have been, we're going to cover everything that's good about the world.
Does good news sell?
Absolutely.
Yeah. That's it's fascinating because I think that could actually be why retail investors have been buying into the stock market, because they're still on the American exceptionalism narrative, having opted out of Sell USA. And arguably the institutional capital is being reshaped and reallocated. That could be part of what it is. But very interesting in terms of the thing. Where else has the money been going? Well, clearly to non-US stocks. And this is just the ratio of S&P to FTSE All World, ex-US. We can see that it has continued to trade at quite a premium and to really leave the rest of the world behind. and that's been turning. And there's been a lot of focus on this downturn piece, the bit that it's been turning, but you can see it's still got quite a ways to go in terms of just the S&P has still significantly outperformed other indices. So yeah, we may have turned and it may be a soundbite and a headline, but we still are probably in the US quite a bit overvalued relative to Europe, which suggests that Europe could have quite a bit of legs in terms of this recovery. And equally that it is less susceptible to a downturn in markets, that the European pot perhaps is not something the same as the US pot. We've less equity market participation and less generally probably more insulated from that kind of dependency. So I think that may be coming close to the end of the, oh no, we have a little bit more to say on private equity, which we were discussing. And I think this is an interesting example of, again, just headlines capturing a trend, which may not in effect be a trend. We have the Yale Endowment CIO saying that success in the next 4 decades will look a lot different from success over the last 4. And they're trying to offload, it looks like, a significant portion of their private equity portfolio. They've engaged Evercore, and I think it's $6 billion in total. And this is signaling that private equity may have peaked. We see Canadian pension plans looking to invest more at home. And this probably just translates a little bit into just a bit of a strange fundraising environment, I would think. And certainly a healthy secondary demand, certainly in terms of supply, so to say more than demand. Again, the question of whether the pricing will be met. Clearly, the Norwegian Wealth Fund does nothing in private equity, but these kind of numbers to lose 40 billion on tech weakness, just they're the kind of the headline numbers that just I think show the exposure of some of these strategies. So whether private equity is going to be the next shoe to drop, I think we don't know. And then finally on the dollar, well, I mean, the chart here shows even since April 2nd, just the trajectory of gold, the downward trajectory of the dollar, downward trajectory of the S&P. It's at a 3-year low now. And is that going to be now compounding investor confidence? I'd argue that technically the dollar should have some support if the Fed is standing firm on rates, where Europe is at its 7th cut. But clearly this vote of confidence in the US is continuing to percolate. So what do we do as investors? Well, we cannot possibly trade around that volatility that we saw. I think that's safe to say. We have been counseling the diversified portfolio, exposure to the Netflix, to the Walmarts, to the kind of the balance that will still be there in demand. And I think just to go back to the beginning where we talked about the idea of this is just geopolitics behind the scenes, the sell USA, the sell USA momentum, that clearly is overdone. I think we talk about clearly markets are not falling to zero. We have strong fundamentals, strong pipelines of drug research, etc. But it's a question of whether the narrative gets often so overdone. On the geopolitical front, I think we know that this behind the scenes, it's not getting attention, but there's still a lot of, I say, shambolic processes in place around the world from a geopolitical standpoint that are no closer to being resolved. And I think that is kind of chipping away perhaps at the kind of the first 100 days of the Trump administration's it's a set of achievements. Again, maybe people have switched off. They could well have switched off and not be paying attention to this. And the approval rating, I didn't show a chart, but approval ratings are still relatively high within the US, I think, for the administration right now.
So he's down 7%.
On the economy, right? And his management of the economy.
Is that what it is?
Yeah, I think so. Yeah.
The economy is flipped to negative slightly, but immigration continues to be very strong. So that
yeah. So I think this is great. Thank you very much for coming and for sharing the perspectives of Europe. I think that's given us a lot of fresh insights and for kind of coming and chewing over the news the week that it has been. And we'll sort of brace ourselves for what the weekend may hold and see where we go from here. But